If you want to avoid market fluctuations in the equity stocks and are more risk averse, then consider investing your money in the debt-oriented mutual funds. But what exactly are debt-oriented mutual funds? Let us try to understand through this video. Before we can understand how and when to use debt funds, it is very necessary for us to understand the fundamental concept, which is debt itself. To make you understand this, I will take a simple example. Assume you want to buy a car. After doing a lot of research, you have found a car which has all the specifications which you desire, and the car is going to cost you 15 lakh rupees. You have 5 lakh rupees of money available in your bank account which you will use it for making down payment. But still you need 10 lakhs more for purchasing this car. How you will source this additional funds? Chances are you will approach a bank and request a loan from them. Now the bank will do a lot of background work like checking your CIBIL score, your sources of income, IT returns, etc. and then they will decide whether to sanction you a loan or not. Assume the banker is satisfied and gave you the required amount of loan of 10 lakh rupees and they will make you sign an agreement which we generally call it as loan agreement. Now this loan will become an asset of the bank and it is a liability for you. This is the simple debt structure. Now let us try to extend this concept of debt further from the business perspective. Imagine a manufacturing company wants to build a new plant. The company needs about 100 crore rupees of money to install this plant. How can the company raise this money? There are two ways by which the company can raise this money. Number one, approach the bank and get the loan, pretty much like the car case which we discussed. Number two, instead of approaching the bank, the company can raise smaller amounts of money from several people, generally called as investors. Now, instead of paying the interest to the bank, the company will pay interest to these multiple investors. If the company takes the first approach and seeks a loan from the bank, then the binding agreement will be called as loan agreement. On the other hand, if the company raises the money from multiple investors, then the binding agreement between the company and those investors will be called as bond. A bond is nothing but a promissory note given by the company to its investors or lenders, promising to repay the principal amount at the end of the tenure and also pay periodical interest amount, generally referred to as coupon. The bond market is a reasonably big market, not just in India but all over the world. Companies often issue bonds to fulfill their capital requirements and these will be subscribed by investors. Now we have enough of fundamental knowledge to understand what debt funds are. If you buy the units of equity fund, the fund manager uses that money to invest in the shares of the companies. On the other hand, if you buy the units of the debt fund, the fund manager utilizes the same for investing in the bonds of the companies. This is a simple difference between equity and debt funds. Do you want to know what are various kinds of debt funds? Then subscribe to our channel and wait for our next video.